Hey everybody, this is another episode of Green Spud Trades, and today I want to talk about the blowup of the XIV fund. So, for those of you who are unfamiliar, the XIV is an exchange traded note that bets against volatility in the stock market. So, what this means is that the XIV and a similar fund called SVXY, they take positions in VIX futures on the Chicago Board of Trade Exchange. They take short positions in anticipation of volatility remaining low. Now, a lot of people have profited tremendously from this security over the past several years because the uh, the VIX futures tend to be in a state of what's called contango, which means that the current month is less expensive than the next month. So when the contracts roll over, if you're long, you have to spend more money to buy the next month. But if you're short, you actually gain some money going from month to month. And so these contango gains have really compounded and helped people who were long a position in XIV or short a position in overall volatility. You'll see if you look at the XIV chart that during times when volatility is low and the general stock market is going up, you get tremendous returns of, sometimes 10 times. So this trade has been very popular among retail traders, but last month at the beginning of February, this fund completely blew up and it's since been recalled. So what happened is because the XIV is a short position, that means it's vulnerable to an increase of 100% or more in the VIX or the VIX futures. So if you're short a position, any type of stock position, if the stock that you're short doubles, you've lost 100% of your money. 100% up is 100% down, which is zero. And then in a short position, you could lose significantly more than the amount of money that you put in, because like if the stock triples, well then you owe another whatever the value of your initial investment was. So you could easily a lot of accounts get destroyed by being short this way, because stocks, they could go up more than 100%, and then if you're 100% in the account, then you owe more. It'll cost you more to buy back the stock than what the account's worth. And this was exactly the situation that the XIV exchange traded note was in when the VIX futures more than doubled in a single day. So the reason that this hasn't happened before is because the XIV, its returns are intended to mimic the daily returns on the VIX futures. So that means that if let's say the VIX futures makes a 20% up move in a single day, the XIV will decline by 20%, but then it resets for the next day. And then so at the start of trading the next day, if the VIX futures go up 10%, then it will go down. Then it will go down 10% as well. So you could have a series of consecutive days where, like we've had in financial crises before, where the market just has a bad run and goes down, and the VIX might spike from the low teens and go up to 40 or something like that. That hasn't broken the XIV completely, because in all past circumstances we've had ramp ups in volatility take place over a number of days. So the XIV was able to reset, and it never lost more than 100% in a single day. It's had some significant drawdowns, but it hasn't had them all come at once. So what happened at the beginning of February of 2018 was very unusual. In fact, it was the first time that the VIX ever moved that way. It was the biggest single day move in the VIX that ever occurred. And here I'm going to put up a little chart showing you that, showing you some of the past single day moves. So I always knew that this could happen, and there's even a contingency in the prospectus for the XIV talking about it, that they could recall the security if there is an 80% move, down move or more. But it seemed like such a far-fetched event because we've had things like the 2008 financial crisis happen or the 2010 flash crash happen, and we've never seen that type of a move in volatility. But it was very odd to me that on a seemingly normal correction type of day for the stock market, that volatility had such a strong move. Now, I'm making this video because I think this is evidence that markets are manipulated. Especially the stock market is manipulated. Markets are finite. In the stock market, there's a finite amount of liquidity, and just like how Maynard Keynes says that the market could remain irrational longer than you could stay liquid, I think that happens a lot. And there are traders, well, not even traders, but probably funds or just rich pricks who have a lot of money and take advantage of that. So another piece of evidence that I think, actually, I think the smoking gun that this was some type of manipulation is the fact that the XIV blew up happened in the after hours market. Right after the close of regular trading hours at 4 p.m., there was a sudden sustained move in the VIX futures. So the VIX futures, they had a rough day, but it wasn't enough to kill the XIV fund. The XIV fund got killed after the market closed in the after hours. So somebody with a lot of money they were waiting for a bad day probably, and saw that the VIX futures were up, and they knew if they put in X amount of money, X billions of dollars, they could take advantage of the low liquidity of that hour and push it to a place where it would destroy the XIV. It's pretty clever plan, actually. The Chicago Board of Trade, they only started doing extended hours trading of VIX futures, I think it was in 2015 or so. It's on their website. But yeah, this was a relatively new thing, and I think that was that opened up this vulnerability in the XIV fund. So I'm just making this video to let you know. I mean, if you ever feel like the stock market game is rigged, it probably is. You have people out there who will cheat whatever ways they can to make money, and it's legal. They're going to get away with it. It's just that the guys that you hear about, like Bernie Madoff and such, they get caught. But the stock market is a game where there's not just an asymmetry of information, but an asymmetry of trading power. So, markets, they're finite. There's only so much liquidity that's there at a certain time, and there's people with a lot of money who can manipulate the markets with the clout that they have and take advantage of the liquidity, and they could force other people to liquidate because portfolios are, their value is judged by mark to market, and if certain liquidity events happen, like if you're short a stock, you get margin called if the position goes against you so much, if you're losing so much money. And that is I'm not saying that's fair or nice, but it's a trick that's commonly used in the stock market. So the scary thing about this is somebody out there knows how. Oh, by the way, Stephen Anson, a very successful trader in volatility, he made a tweet about this. Calculated that it would have taken about $10 billion to do this, and they walked away with about a $3 billion profit. And he probably just did the calculation based on, based on like the number of shares traded versus times the price. It probably took a lot less than a lot less than that for them to pull this off, because there probably were other traders that joined in and joined in on a momentum. So, you probably didn't need $10 billion. You probably could have done it with like 1 billion. But still, they know how to break this security now, which means it's very dangerous. So if you're going to trade the remaining fund, the one that didn't close, the SVXY, I suggest that anytime you take a position, just try to hedge it somehow by taking some stock options, buy some puts or something like that, so that if it blows up overnight again, you won't be caught with a total loss. So that's pretty much all I have to say today. I just wanted to have a comment on the XIV blowing up. Let you know that there's evil out there in the stock market, and there's people with advantages out there, and you just got to be careful of stuff like that. If something can break, it probably will. And I think that the reason that black swan type of events like this, no matter how sophisticated the models are that even professional investors come up with, to show that an event is very unlikely to happen, happens anyway, because when somebody's taking a big enough position in something, that means that they're going to run out of liquidity at some point, and by intention or not, the stock market itself could, in sort of a reflexive way, come back and force liquidity, cause forced liquidations. And that's how counterparty risk happens. That's how these 2008 sort of styles happen. But yeah, those are just some thoughts on the XIV blowing up, and I will see you next time.